Hi, welcome to our monthly podcast dedicated to all things investment trusts. I'm Dan Coatsworth, and joining me on this week's show is Laith Khalaf.
Yeah, hi Dan. We've had some really good feedback from listeners about this bonus podcast and the type of stuff you want us to cover. So please do keep sending in those suggestions because, of course, it really helps us to shape the programme. The email address to write into is podcast@ajbell.co.uk.
Now, Emma Bird from Winterflood was on the podcast at the start of the year to talk about discounts with investment trusts, and we've subsequently had several questions from listeners on this topic. So we're delighted to bring Emma back onto the show.
Yeah, Emma will be here shortly to answer one of those questions. Dan will also be talking about whether the start of the new tax year has been a catalyst for discounts to narrow in the investment trust space.
Now, Tom Sieber from Shares Magazine is on the show to talk about Scottish Mortgage's latest results. We've also got Martin Gamble and Ian Conway doing a deep dive into City of London Investment Trust. And that's one of the most requested trusts by listeners. So thanks again for sending in your suggestions.
And I'll also be explaining the difference between an open-ended fund and an investment trust. But first up, let's start with a bit of news.
Yeah, we thought it would be interesting to look at the biggest rises and fallers among investment trusts since the start of the year. So to reveal all, here's Tom Sieber.
Thanks, Dan. Yes, so the three top performers so far this year are all quite specialist names. And top of the list is Seraphim Space Investment Trust. And that's benefited from renewed investor interest in the space sector. There's been a few things grabbing investors' attention recently. So there's been some M&A activity. BAE Systems, the UK defence company, recently bought a company called Ball Aerospace in the US, which is a manufacturer of mission-critical space systems in a £5.6 billion deal. And there's talk that Elon Musk's SpaceX, the privately listed space company, might carry out its next share tender at a price which could value the unlisted company at around $200 billion. And that's helped to boost the profile of both Seraphim and the space sector. And if you look to their most recent first half results, which came out in March, the company's been making some new investments, making some follow-on investments. And one of its largest holdings, a maker of microsatellites called EYE, it moved into profit at the EBITDA, so earnings before interest, taxation, depreciation and amortization level during the period. So that's been the top performer. It's up around 80% year to date. So investors in music royalty outfit Hypnosis, which comes in second on the list in terms of the year to date performers, have effectively been put out of their misery after a very up and down time on the stock market. After a bid came in from the majority owner of its investment advisor, a private equity firm called Blackstone. And then third on the list is Baker Steel Resources Trust. That was trading at a very pronounced discount to net asset value. It invests in privately owned junior mining companies. And those companies have been hit by high interest rates, rising costs, and a series of geopolitical headwinds. That discount has narrowed, although it still remains quite significant, as commodity prices have increased and as some of its key investments have moved into production. Now, looking at the kind of flip side, the three worst performers, they all also operate in niche areas, but those areas have proved far less fruitful so far in 2024. So Asian Energy Impact Trust, which is an Asia-focused renewables investor, is being wound up. It got itself into a bit of a mess when costs for a solar plant that it was developing turned out to be higher than anticipated. That led to a suspension as results were delayed, and the trust eventually pulled out of this investment and wrote it off. And it's never really been able to recover from that setback. And as I say, it's now being wound up. And then staying in the kind of green energy space more broadly, Gresham House Energy Storage Fund has been a victim of external problems to an extent, with National Grid running into some issues with a new software system. And that meant the electricity that was being stored on the grid was being used much more sporadically. There's also been quite a slow pace of new projects being added to the grid, thanks to elongated connection times. And that's meant that the kind of revenue that both Gresham House Energy Storage but other similar funds, the revenue that they would normally get has been significantly reduced, and that's affected their ability to pay dividends. did report a slightly more encouraging performance for the first quarter of 2024, suggesting that some of these problems are being sorted out, and it's looking to dispose of a subset of assets which could help prove up some of the value in the portfolio potentially. And then finally, in terms of the worst performers, Life Sciences REIT, which joined the market at quite a difficult time really for trusts when interest rates were just about to turn. It's looking to tap into demand for labs from life sciences firms, but it's been hit by the higher interest rate environment and also economic uncertainty, which is leading occupiers to postpone rental decisions. And ultimately, in March, it was forced to cut its dividends significantly.
Thanks, Tom. So we've had a listener get in touch. They're listening to previous episodes of this investment trust podcast, and they raised quite an interesting question about discounts. So the listener said that they know that you do get discounts to NAV with quite a few investment trusts. It's easy to understand why it happens if they're illiquid. Perhaps they're reflecting the uncertainty of the value of the assets. If there was to be, say, like a sale today, tomorrow. But what they're unsure about is understanding what the discounts represent if the underlying assets are liquid. So they give the example of India Capital Growth Fund. They say that all of its assets are liquid shares. Now, they may not be sold immediately, but perhaps it would only take a day or two to get those deals through. So to try and understand what's going on here, great to bring back Emma Bird from Winterflood. So Emma, thanks ever so much for joining us again.
Thank you.
So if we just sort of take go through some of these points in this listener's question. So first of all, perhaps why do discounts exist on investment trusts where the assets do look like they're pretty liquid? So a good example might be US or Indian equities that sit inside an investment trust portfolio.
Yes, I think that's a fair question and not obvious to see. Investment trusts that invest in liquid equities pretty much always publish daily NAVs. So investors theoretically should be able to see exactly what each share is worth. You would think that people would be willing to pay that amount for that amount of assets, but that's not how it works. Share prices of the investment trusts are determined by the demand for that trust, and therefore the share price can differ from the NAV and trade at potentially a premium, but at the moment more likely a discount to that. So varying reasons for why maybe the demand isn't there for the investment trust. One thing could be if the underlying asset class is out of favour. So if investors expect the NAV to fall over time, they might not be willing to pay the kind of full price now, or even if they just prefer other asset classes, they'll be investing in different investment trusts or companies or funds, and not to the particular investment trust that is trading on a big discount. We can also see maybe if investors don't like a particular proposition or manager, or a particular investment trust has underperformed historically, there's likely to be less demand for that trust versus its peers, and therefore it's likely to trade at a bigger discount. I think the liquidity of the investment trust itself is also an issue quite a lot of the time. You mentioned the liquidity of the underlying assets, that it is also important, but the investment trust itself is a company, and some of the larger investors in the market have issues with the liquidity of the investment trust itself, and aren't willing to pay as much if they're worried about the price they would actually be able to get out at if they needed to sell their shares in the investment trust.
Now, with UK equity investment trusts, it seems like the smaller the company in the underlying portfolio, the greater the chance that this investment trust will trade at discount. So I can understand why sort of perhaps really small company shares inside an investment trust portfolio might not be very liquid, and so hence why you do typically see a discount, but surely mid-cap stocks. So these are ones you probably find in the FTSE 250 index. I mean, surely they're liquid. People will be able to buy and sell those all day long. So why would a mid-cap UK equity trust trade at a discount?
So I think something to mention is that it's not always the case. We do see some smaller some investment trusts that invest in small cap UK equities are actually trading on a premium at the moment. So there's Odyssean Investment Trust and Rockwood Strategic, for example, invest pretty far down the market cap spectrum, but they're trading on small premiums at the moment, which I think is kind of attributable to their strong long-term performance and differentiated offering. But yeah, I think it generally, for example, if you look at the UK smallest company sector, it does trade at a bigger discount than, for example, the UK equity income sector. I think part of that is the income and the dividend growth that the UK equity income sector provides. So investors like that income and are willing to pay kind of a higher relative price for funds in that sector. Also kind of touching on what I mentioned earlier about the underlying assets being out of favour, I think you can probably say that about UK small caps and even UK mid caps to an extent. I think they're generally at least viewed as being more exposed to the domestic economy, and so the kind of concerns over the UK economy has meant that there's been less demand for UK small and even mid cap investment trusts.
So if someone was to look at perhaps a handful of the more popular sectors that you might find with investment trusts, so I was thinking things like global equity, UK oil companies, UK equity income, Europe, and perhaps the technology sectors. What sort of discounts could they find at the moment? And is it fairly easy to understand why these discounts exist, if at all?
So I mean, at the moment, the global sector's on 6.5% discount. UK all companies is on about an 11% discount. Interestingly, that's actually in line with the UK smaller companies sector. But the UK all companies sector does actually tend to include some small caps as well. UK equity income is on a bit of a tighter discount at around 6%. Europe's at 7%, and technology is at 9%. I think things that kind of stand out to me there, I think technology is perhaps one of the most surprising to be on quite a big discount, despite the current popularity of the Magnificent Seven stocks that these funds do have exposure to, and they have performed well, even relative to kind of indices dominated by that Magnificent Seven. So that maybe stands out as one of the most perhaps surprising discounts there. And yeah, as I touched on earlier, I think that UK equity income being on the narrowest discount of those, I think that is helped by the track records of dividend growth that many of these funds have delivered, which has been helped by the investment trust structure and their ability to use revenue reserves to top up earnings and continue to increase dividends in difficult times. In terms of kind of understanding these discounts, that these are averages, and the ones I just listed are weighted averages. So the bigger funds in those sectors will have more of an impact on the average. So if we take the global sector as an example, as I said, that's on an average of about 6.5%, but there is a big variation within that. So we've got for example, Lindsell Train Investment Trust and Keystone Positive Change on the widest discount, so on 20% and 11% discounts, respectively. I think that reflects their out of favour high growth approaches, and then that kind of less wide discount, but still pretty wide, especially relative to where they've traded previously. We've got Monks and Scottish Mortgage on around 8-9% discounts, two more Baillie Gifford global funds there. Again, high growth approach that has been out of favour in a higher interest rate environment. And then towards the other end, we've got Alliance Trust on a 2% discount, which is another big fund in the sector, but's performed well and has kind of helped control its discount through share buybacks. Similarly with funds such as Martin Currie Global Portfolio and Midwind International, both on small discounts, 1 or 2%, because they have strict discount control policies in place. So it's important not to just look at the average for a sector. I think you do have to kind of dive in to see where the variations are.
And do you have any idea how those compare? I mean, say on the sector basis, how they would compare to the sort of the historical trends? Are these this is perfectly normal, or is it something like technology? This is a once in a lifetime chance to get something way cheaper than perhaps you'd normally see it.
So for technology, we take that as an example. Discount has varied over time. So if you look over the last 10 years, it's traded on an average discount of 3%. The current 9% discount is a lot wider than that very long-term average. But if you look at all those sectors over the last 5 years, they're not too far out of line with their long-term with their 5-year average discount. So what we've seen over the kind of last 5 years is discounts rebounded strongly after the pandemic, and we're trading at quite tight levels versus history. And then we saw a really sharp discount widening over 2022 and 2023 in the kind of rising interest rate environment, as well as some investment trust specific issues. But we have actually started to see a bit of a recovery so far this year. So I think there are still some value opportunities in the investment trust sector. Discounts are still wide for many individual trusts, but not sure it's a once in a lifetime opportunity at the moment.
So I know obviously you can't give advice, but I mean, what would you say to someone if they said, well, look, if I do see a bigger than historical average discount, is that a signal to I should buy, or is it actually you shouldn't always expect something to sort of revert back to norm if you do see this sort of bigger opportunity here?
I think spotting an investment trust on a much bigger discount than its historical average, I think that can be an interesting signal to look into it further. It could well be a good value opportunity. There could be something kind of slightly technical, meaning that it's trading at a wide discount and can offer an attractive opportunity if you look into it and you like the assets and the manager and kind of have a good outlook for it. But you also do need to check whether there is a kind of justified reason for that current discount being wider than historically. So there could have been potentially a change of manager, or even a change of strategy, or a change of discount control policy, meaning that actually the current discount is at a new wider level. So those are kind of things internally that might have changed, but also the kind of general macro environment may have changed. So I know this session is mainly focused on equity investment trusts, but if we take, for example, the infrastructure and renewable energy infrastructure investment trusts, they are trading at much wider discounts than they have done previously. They were trading on premiums previously, and that is almost entirely reflective of the change in interest rate environment, with their yields being less attractive in this environment, and concerns over the impact on the underlying asset valuations as well. So I think it can be an interesting initial signal, but you do need to do more research into it to see if there's a justified reason.
Well, brilliant. Emma, thank you ever so much for talking about this discount topic. It's really good. So thanks again for coming on the podcast.
No problem at all. Thanks for having me.
So it's just worth noting that we did record that interview with Emma a few weeks ago. So some of the discount figures that she was mentioning might have changed. But just while we're on the topic of discounts, I did see an interesting research note the other day from Stifel, which was sort of raising the question, does the change in the capital gains tax we've just seen from the start of April, did that actually have an impact on how investors were repositioning portfolios in terms of investment trust? So for those who perhaps aren't aware of the rules, so capital gains tax allowance halved to £3,000 from the 6th of April 2024. Stifel raised a question whether there was quite a few trusts that were already very weak, but they seem to be getting a lot weaker in sort of February and March. So they looked at a few names like Pantheon Infrastructure and GCP Infrastructure. Now they said that, if you look at the sort of the trading patterns with those shares in February, March, and compare them to the start of April, there's definitely a switch. They say that both these trusts saw a sharp recovery in share price during April. And on a sort of total return basis, they jumped up about 8%. So I think it's really difficult to sort of say, yes, this is a clear example of, perhaps people were taking advantage of the change in the capital gains, perhaps that they were locking in some losses that they could use to offset against any capital gains they had before the change in the rules. But I guess there isn't. You can't make any assumptions based on just a handful of trusts. But Stifel seem to think that it is a factor to consider, and perhaps going forward, it's something to think about if we do see any more changes with capital gains trusts. How trading patterns do shift in the sort of the lead up to the end of the tax year and then the start of the next tax year. But anyway, I just thought I'd just throw it into the mix, something to think about. But let's move on to the next segment where Laith can show off all his knowledge about the fund world, namely the difference between an investment trust and an open-ended fund. So Laith, where do you want to start with this one?
Yeah, so I think it's just a relevant question for people to consider, obviously, thinking about investing. Do you invest in an open-ended or a closed-ended fund vehicle? So there are some very important differences. I think the slightly cagey thing is that most of the differences you could either view as a positive or a negative for investment trusts or open-ended funds. So probably best to start with the big one, which is that investment trusts can trade at a premium or discount to the value of the underlying portfolio, or the net asset value, or what we like to call the NAV for short, because we like acronyms and we love shortening things. So, open-ended funds don't trade at a discount or premium. They always trade at that underlying value of the portfolio, the net asset value, because they're open-ended. Shares can simply be created or cancelled by the fund provider. Now, as I say, you can view that positively or negatively. Some investors might quite like the investment trust discount because they think they can grab themselves a bargain from time to time. Though it does have to be said that supposes that if you're buying at a discount, when you come to sell, you're doing so at closer to the net asset value because the discount is closed or maybe even moved to a premium, and that's by no means guaranteed. Depends when you buy and sell, of course. The discount is also good for income seekers because it boosts the yield you get from a portfolio of shares compared to simply buying them on the market, because you're effectively buying them at a cheaper price. And on the flip side, you might actually think, well, why am I buying or selling at a discount or a premium to the value of the portfolio? Isn't that quite complicated? Why can't I just buy in at the net asset value? And a lot of investors might well take that view because after deciding what market you're going to invest in, which trust you're going to invest in, which manager you back, you also then have the question to address, which is now a good time to actually buy into this investment trust because it's trading at a particularly appealing discount, or maybe it's just gone to a crazy premium or whatever. So I think that added layer of complexity does put some investors off, probably actually more advisors and big pension funds rather than individual investors, I think. But open-ended funds do solve that problem because you can kind of buy and sell at the NAV. So, swings and roundabouts, I think, but obviously kind of the investment trusts trading at a discount or premium with unit trusts or open-ended funds more generally, you don't get that.
I think, investment trusts also trade a live price throughout the day, whereas funds work on a forward pricing basis. And I think obviously that's a key point that people need to get their heads around if they want to sort of weigh out which ones to choose.
Yeah, that's right. And, that probably makes trusts more favorable for investors who like to invest more tactically, maybe even a bit more short term, and like to get a precise price for the trust that they're buying. Because, with an open-ended fund, you place a buy or sell instruction and it takes place at the next valuation point, which is normally the next day. So you actually don't know what price you're going to get. And that can also make things a bit more difficult when you're switching investments, because you generally have to wait for your open-ended fund to be sold before those proceeds are then available for you to reinvest elsewhere. Whereas with an investment trust, you get a price, there you go, you hit the sell button or the buy button, and the trade is placed. Now, if you're a long-term buy and hold investor, I actually don't think it makes a huge amount of difference, because if you think about it, if I'm going to hold an investment for 20 years, it's going to make a negligible difference to my returns, whether I buy at price at 3 p.m. this afternoon or at midday tomorrow. The thing that's going to make the most difference to my returns is going to be what happens over that 20 years, not what happens between today and tomorrow. But yeah, so with investment trusts, you can get the live price, and as I say, that will be preferable to some investors.
And I think another point that perhaps investors need to get their head around is how the closed-end nature of investment trusts actually makes them more suitable for investing in a liquid assets, doesn't it?
Yeah, absolutely. Absolutely. I mean, there's a big problem with open-ended funds buying illiquid assets. And what we mean by illiquid assets is things that just can't be bought and sold quickly. So we're talking about things like infrastructure, we're talking about things like property, and unlisted shares. And we've seen how that could unwind very unpleasantly with the Woodford crisis. But there are less dramatic examples, and your classic example is probably commercial property. So if you think about a building like the office building, like the Walkie Talkie in London, or a shopping centre like the Bullring in Birmingham, you can't just buy and sell those things at the drop of the hat in the same way that you can with, say, a share in Vodafone or BP. So that creates a problem for open-ended funds that are investing in those assets, because the investors in the funds can elect to buy or sell their fund whenever they want. And so if there are very large amounts of withdrawals, the fund managers are then found, well, I need to sell the walkie-talkie, or I need to sell the Bullring in Birmingham. And that's not an easy thing to do. And so what we actually saw is, in times of market stress, what's happened is that a lot of open-ended funds have actually prohibited withdrawals. And also the fund managers have held large amounts of cash so that they can meet redemptions from investors. And you don't have that in a closed-ended fund, because the shares are traded on a secondary market between investors. There are no flows into and out of the fund. So the trust manager doesn't suddenly find themselves having to sell an office block in double quick time just because investors want their money back. Now, in times of market stress, you do tend to see trust discounts widening in those sectors. So there is a cost for the liquidity that investors have, but at least that liquidity is there, which probably makes investment trusts preferable for those illiquid assets. And just finally, Dan, just two features of investment trusts that I do also think are worth mentioning. Investment trusts can borrow to invest, and many do that. And what that tends to do is it amplifies the long-term returns from investment trusts. But it does also lead to greater volatility and bigger downdrafts when the market is falling. And the second feature is that investment trusts can also hold back dividends in good years to pay out in the bad. That doesn't mean that they pay out more income than open-ended funds altogether, but it does mean that you can get a smoother journey. So that can be particularly appealing for income seekers.
Thanks very much, Laith. I hope our listeners enjoyed that. And we do try and have a bit of educational content on this podcast each time. And if you've got any suggestions or things you'd like us to sort of perhaps turn complicated things into plain English, please do get in touch. It's podcast@ajbell.co.uk. So let's move on to Scottish Mortgage, one of the most widely held investment trusts among retail investors. So had its latest financial results out the other day. So to help understand what's going on, let's bring back Tom Sieber.
Hi, Dan. Yes. So I guess the key headline from Scottish Mortgage's latest set of results was that after in shareholders enduring 2 years of negative returns in both in terms of their net asset value and also in terms of the share price, the company posted a positive return over the past year. Probably the most striking thing was the strength of the share price as opposed to the NAV, which was sort of trailed behind. And that was a function of the big discount that there was on Scottish Mortgage narrowing significantly over the period. Perhaps inevitably in the results, they highlighted significantly what they've been investing in terms of AI. You know, they've obviously very cognizant of the fact that that's a big area of focus for investors at the moment. There were some interesting sales on the part of Scottish Mortgage. So they sold out their position in Tencent, which they'd held for a very long time. That's basically a Chinese mobile platform. And I think the references they gave were to issues around political and regulatory headwinds in China. So that's obviously something they're becoming more aware of. And they also sold out of a genomic sequencing specialist, Illumina, which some people may be familiar with, because basically the execution on the part of that company had not been that great. So, I mean, it was clearly a set of results that showed progress for Scottish Mortgage. Interestingly, Investec, which has sort of been quite negative on Scottish Mortgage for some time, retained a kind of pretty downbeat stance. It talked about Scottish Mortgage having a moral obligation to try and keep the discount at the current level. And just to give a bit of background, Scottish Mortgage has been buying back shares in the market in order to bring the discount in, and that has been successful. So the discount was around 25% at times last year, and it's right down to sort of single digits now. But it basically, Investec thinks that, you know, it has, like I said, a moral obligation to continue with that. It compares it to a policy that Alliance Trust brought in 2017. So it's basically saying, look, if the discount starts to widen again, you know, you've got to keep buying back shares to keep it at around the current level. It's also sort of remains concerned about the balance sheet and the relatively high level of gearing in the trust, and also the fact that it owns a lot of private assets, which obviously are more difficult to value, and that has implications for then how the trust itself is valued by the market. Having said that, one of its largest holdings, one of its largest private holdings, we touched on earlier, which is Elon Musk's SpaceX, and as we discussed, you know, that's considering a tender offer, which would imply a $200 billion valuation. So, you know, that would be helpful in terms of showing the sort of the value, some of the value in the privately listed component of the portfolio. And it's quite striking. One of the things that kind of accompanied news of a share buyback at Scottish Mortgage was the fact that Elliott, the US activist investor, had joined the shareholder register and had taken a meaningful stake in the trust. And earlier in May, it emerged that they had started to trim their position to take some profit. So it suggests that Elliott potentially is happy with some of the steps that Scottish Mortgage has taken to address the discount and kind of improve performance.
Okay, thank you very much for that, Tom. And we've got time to talk about just one more investment trust, and that's City of London, which is a popular investment choice, particularly with people in retirement. Shares Magazine journalists Martin Gamble and Ian Conway are on the case to find out exactly what makes the trust tick.
The trust has been around for a long time, and it's designed to invest primarily in UK equities. So 60% of the portfolio is invested in large cap UK equities, with the rest medium, small UK companies, and up to 20% in overseas equities. And it's really designed to grow in a sustainable manner both the income and capital of the trust's funds. And so that's what it's designed to do. And it's been very successful at it for many, many, many years. I mean, the trust has a very long history, but the current management under Janice Henderson took over management of it in 1991 under Job Curtis, and it's had a very impressive track record since then.
It's actually gained popularity in the last couple of years, where a lot of investment trusts have been sold off. This one has actually been quite in strong demand.
It has, yes. In fact, over the last, up until recently, most recently, the trust has traded a premium to its net asset value. So there's been good demand for it from, I think, people that are approaching retirement, they see it as a very conservatively managed, sustainable, reliable income play with also some capital growth in there as well. So it's become popular with that sort of cohort of investors, which has swelled the assets. And in fact, they just took advantage of that, and they were selling shares when they were trading at a premium. And now it's trading at a very small discount, around 2-3%. It's engaged in buying back shares to try and narrow that discount. In fact, I think they claim that it's the longest running increase in the dividend in the whole sector, running on 57 years now. They've increased the dividend.
Wow. How do they do that? Do they just go and buy high yielding stocks?
They call those sort of value traps. They're very diversified across different industries, but they're primarily interested in quality companies that have strong balance sheets and sustainable income, rather than the ones that just happen to have strong dividend yields at the moment. They call those sort of value traps. So the manager is very much conservatively mindset. He's got a very conservative mindset, and so he's really more interested in the quality side of things and safe balance sheets and the sustainability of the dividend rather than the actual size of it. But I mean, at the moment, the trust has, I think, closing on a 5% yield, and it pays out dividends quarterly. So it's got an attractive yield, and it's got a very strong history of growing that dividend. And because it's an investment trust, for listeners that are not aware, they don't have to pay out all of the income they receive, so they can, in the good times, they can put some of that to one side into what they call revenue reserves, and then in the bad years, they can dip into those reserves and continue to maintain, or sometimes grow the dividend. And this trust, during the pandemic, 2020 and 2021, actually did continue to increase its dividend, but it did that by dipping into those revenue reserves, which is very comforting for investors as well, who want to rely on that income as they approach retirement.
Yeah. And you mentioned Joe Curtis has been running it since 1991. How's it performed over that time?
Well, it's performed very well. I mean, purely looking at the numbers, it's outperformed its benchmark, which is the FTSE All-Share, over the 1, 3, 5, and 10 years, and since inception. In fact, since inception, the total return is up close on 14-fold versus around 11-fold for the All-Share. So that works out on an average annual basis of around 8.7% a year, which is just under 1% more than the benchmark, which is very impressive over that time frame. So they're clearly doing something right.
So, I mean, what's been working for them in the last year or so?
And the last year or so, they've done very well out of financials. So if you look at the way the portfolio is currently positioned, they're overweight banks, around just under 30% are in banks, staples 19%, industrials 12%, energy 9%. But in particular, they've had some good winners in BA Systems, which has almost doubled over since the war with Ukraine. If Russia's war with Ukraine, the shares almost doubled, and the manager sees that as a continuing sustainable trend as more and more countries around the world sort of tool up for potential tensions in the future. They've had some good performance out of NatWest, thanks to its interest rate margin, or net interest margin, which has expanded as interest rates have risen over the last couple of years, and the level of bad loan provisions have remained low. And it's also worth pointing out that NatWest isn't implicated in the Competition Authority's current probe into car finance, unlike its peer Lloyds, which could be on the hook for up to £1 billion in compensation. So they've managed to do very well out of their holding in NatWest. In fact, I think there are 2 or 3 banks that are now in the top 20 positions of the fund, which is the first time that's happened for a while. So financials have done very well for them. And they've also done very well by just staying clear of some of the underperforming shares as well. So yeah, the manager's done a good job in that regard. They recently bought oil company Eni, which is Italian oil business. And over the last year, he sold out of Cisco in the US and Ferguson, which is the old Wolseley distribution business, building materials distribution business. It's listed in the US. It used to be listed in the UK. And they also took some profit out of Sanofi in France, the healthcare business, and recycled some of that into GSK, the old GlaxoSmithKline in the UK. So yeah, he's been very active. And in fact, more recently, they bought Dowless and Inchcape.
You've mentioned Joe Curtis. Has been in the role since 1991. Are there succession plans? I mean, is it something that investors need to think about?
I think they should be thinking about these issues if they're invested in a product like this. Job himself, he looks fairly happy in that he said it's a privilege to be in the role that he's in. But recently, 2021, they appointed David Smith as a deputy fund manager. So one assumes that he will take on the role full time if and when Job decides to hang up his boots. But they're also supported by a very wide team across the Janus Henderson business. And they've got analysts spread across the world as well. So it's not just a one-man band. And the other thing worth pointing out, which we didn't touch upon earlier, is as well as being the trust with the longest track record of growing their dividends, they're also one of the cheapest. I think they cut their fees again. So they're using the extra scale they've been gaining in recent years and passing on some of that benefit to shareholders. So their fees now, as the management fee is 30 basis points, which is very competitive in the sector.
So that was Martin Gamble and Ian Conway. That's all we've got time for on this bonus podcast. The normal AJ Bell Money and Markets podcast will be back later this week, where we'll be talking about AstraZeneca and also chatting with an expert about financial advice. Until then, thanks very much for listening, and we'll catch you next time.